Picture two cars stopped at the same red light. On the left, a luxury SUV, spotless, the kind of grille that costs more than a used sedan. The driver has both hands relaxed on the wheel, sunglasses on, looking like a person who has clearly arrived somewhere. On the right, a dented Honda, faded paint, a crack in the bumper that's been there long enough to feel permanent. The driver looks tired, ordinary, easy to overlook. Now here is the part the light doesn't show you. The SUV is financed at the absolute edge of what its driver can carry, 72 months, a payment that flinches every time gas goes up. There is almost nothing behind it. No real account, no cushion, no quiet, I could lose this job and be fine for a while. The whole picture exists to be seen. It is a front door, beautiful, lit up, and load-bearing in the worst way, because if anything pushes on it, the whole house behind it is empty. The Honda's title is paid. There's a boring account the driver almost never talks about, the kind that doesn't photograph well. If the job vanished tomorrow, there are months, real months, before anything important breaks. That driver looks like less. They are, in the only sense that matters under pressure, more. That is the distinction I want you to carry through this entire episode. There is the part of a financial life that is visible, what you drive, where you live, the way the front of the house looks from the street. And there is the part that is invisible, the safety behind the door, the cushion, the optionality, the quiet, I'm okay, even if. For most of the last decade, those two things drifted in the same direction. The front door and the safety behind it both got easier to build at the same time. And the reason they did is the thing we're actually here to talk about. A single number that almost nobody chose, almost nobody watches, and almost everybody pays. Let me bring in the cleanest version of the mechanism, because this is the logic that finally makes the whole thing stop feeling mystical. I'm going to lean on that logic for most of what follows, not someone else's phrasing, the underlying mechanism itself. Here is the frame. There is one interest rate that sits underneath nearly every other price of money in the country. It's the rate on what's called the 10-year Treasury, which is just a long, formal way of saying the U.S. government borrowed money for 10 years and promised to pay it back. Because the government is considered the safest borrower there is, the return on that loan becomes the thing everyone else gets measured against. It's the floor. It's the, if even the safest borrower has to pay this much, everyone riskier has to pay more number. Nick's phrase for it is the rate floor. And once you see it as a floor, a lot of confusing things click into place. Stay with the plumbing for one more minute, because this is the spine of the whole episode, and I don't want you to take it on faith. A bond is a loan you can buy. You hand over money now, you get paid interest along the way, and you get your money back at the end. When the borrower is the U.S. government, that loan is called a Treasury, and the reason everyone watches it is simple. Nobody seriously expects the government to skip the payment. So whatever return investors demand to hand it their money for 10 years becomes the cleanest read we have on the price of safe money, money with the risk stripped out. Everyone else borrows at that price plus extra, and the extra is just the market's guess at how much riskier than the government you happen to be. The crucial, slightly counterintuitive thing is what happens when new rates change. Imagine you own a bond paying 2%, and tomorrow the world starts offering brand new bonds paying 5%. Nobody wants your 2% loan at full price anymore. Why would they when they can get 5 next door? So the price of your old bond falls until its math works out to something competitive with the new ones. New rates up, old bond prices down. They move opposite each other. Always. It isn't a mood or a panic. It's arithmetic. The interest your old bond pays is fixed in stone, so the only thing left that can move to make it competitive is the price someone will pay you for it. And the longer the loan, the harder it swings. That sensitivity has a name: duration. A loan that doesn't get paid back for 10 or 20 years has more time exposed to the new rate, so its price moves more violently when rates move. Short loans barely flinch. Long loans lurch. Think of it like this. If you were locked into yesterday's deal for one more year, A better deal opening up next door barely stings. If you're locked in for 20 more years while everyone around you collects the better deal, that sting compounds. Duration is just how long your money is stuck inside the old promise while the world reprices around it. Now hold those two ideas together, the rate floor and the way safe money reprices, because here's the sentence that reorganizes everything. When that floor moves, it doesn't just move bonds. It reprices the cost of being you. Let me walk you through an ordinary life, one bill at a time, and show you the floor underneath each one. Start with a house. You find it. You love it. You sit across from a lender and they slide a number across the table, your mortgage rate, and it feels personal. It feels like a verdict on you, your credit, your income, your worthiness. But Nick's point is that the largest single ingredient in that number was decided long before you walked in. The lender starts from that 10-year floor because a 30-year mortgage is long money, and long money gets priced off the long, safe rate, and then stacks their margin on top. Your credit nudges it. The floor sets it. When the floor was low, that same house cost you one payment. When the floor lifted, the identical house, identical price, started costing you hundreds more a month. Nothing about the house changed. Nothing about you changed. The floor moved, and the house got more expensive to carry, even though it never got more expensive to buy. That gap between the price of a thing and the cost of carrying it is where this whole story lives. Now the car. Same machine, smaller. An auto loan is shorter money, so it's less violently exposed, less duration, remember, but it still sits on top of the same floor. When the floor rose, the monthly payment on the exact same car climbed, which is why so many people quietly stretched their loans longer, 72 months, 84, chasing a payment that felt survivable. And here's the trap inside the trap. Stretching the loan to shrink the payment means paying interest for more years at a higher floor on a car that's losing value the whole time. Go back to our SUV at the light. That is what an 84-month payment in a high-floor world looks like. A visible thing, carried on invisible strain. Now rent. You don't sign a mortgage, so you think you've stepped off this ride. You haven't. Your landlord almost certainly has a loan on that building, and when it comes time to refinance it, they refinance into the new floor. Their cost of carrying the building goes up, and that pressure has exactly one direction to travel. It travels to you at renewal as a number that's higher than last year's for a unit that is, if anything, a little more worn out than it was 12 months ago. You never see the floor. You just see the renewal letter. The floor is in the renewal letter. And then there's the part nobody connects to interest rates at all. Your job. Your employer borrows too. To expand, to make payroll across a slow season, to fund the thing that was supposed to become next year's growth. Most companies don't sit on a giant pile of cash. They run on a line of credit, the same way a household runs on a card. Borrowing to bridge the gap between when money goes out and when it comes in. When the floor rises, their borrowing gets more expensive at the same moment yours does. So the projects that used to clear the bar, the new hire, the new location, the raise that was coming, suddenly don't, because the cheap money that made them pencil out got expensive. And the slow season payroll that used to be a routine bridge loan becomes a genuine squeeze. This is the quiet machinery behind a layoff that feels like it came out of nowhere. It didn't come out of nowhere. It came out of the floor. The same number that lifted your mortgage quote can be the number that froze the hiring plan that would have been your promotion. Push it one more ring out, because it doesn't stop at companies. Cities borrow. They borrow to fix roads and build schools and smooth over the gap between when taxes arrive and when bills are due. A city's debt is long money too, bonds that don't come due for decades. So it's priced off that same long, safe floor, with a little extra stacked on for the city's own risk. When the floor rises, the city's interest bill rises, and a city facing a bigger interest bill has the same three options every household has. Cut something, charge more, or both. So it shows up as a fee that's a little higher, a service that's a little thinner, a bus route that runs a little less often, a budget meeting where something gets quietly cut. The floor is in your commute. It's in the line at the DMV. It is woven through public life so thoroughly that we've stopped recognizing it as one number doing one thing. So far, the floor sounds like nothing but a tax on existing. Higher mortgage, higher car, higher rent, shakier job, squeezed city. And for the visible side of life, the front door side, it is. But here's the turn, and this is where the dented Honda gets its revenge. When that floor rises, safe money finally starts paying you again. For years, the account where you keep the money you can't afford to gamble paid you essentially nothing, a rounding error. You'd open the statement and the interest line was a few cents, laughable next to what prices were doing. You were in real terms paying the bank to hold your safety. When the floor lifted, that flipped. Suddenly, the boring, invisible, doesn't photograph well account, the savings, the safe yield, the Treasury you could buy directly, started throwing off real interest for the first time in a long time. The same shift showed up on a slower clock, too. Open a retirement statement, and the safe, boring slice of it that had been dead weight for years was finally pulling something. The exact same number that made the visible side of life more expensive made the invisible side of life finally productive. That is the whole asymmetry of this era in one line. A higher floor punishes the part of your life that's borrowed and rewards the part that's saved. It taxes the front door and pays the safety behind it. And this is exactly where a second contrast matters, because it sharpens the point. A different question opens up once you stop asking only, what does this cost me, and start asking, where does my money arrive from? Because there are really only two kinds of money in a life. There's money you have to go out and earn, trade your hours for, show up for, get tired for. And there's money that arrives, that comes in from something you own while you're doing something else entirely. A paid-off asset, an account throwing off yield, a bond quietly paying its interest on a schedule that has nothing to do with whether you went to work, a thing that pays you whether or not you got out of bed. When the floor was on the ground, owning safe things paid almost nothing, so the only real way to get ahead was to earn harder and often to borrow to look like you were getting ahead faster. The whole incentive pointed at the front door. Chase the income, finance the lifestyle, let the visible side do the talking. But when the floor lifts, ownership of safe, boring things starts arriving, and the people positioned to receive arriving money get a quiet tailwind, precisely when the people carrying borrowed money get a headwind. Same storm, opposite sails. The borrower's payment goes up the same month the saver's yield goes up, and they're standing in the same economy, reading the same headlines, having completely opposite years. That's the optionality this contrast keeps pointing at. Not be rich. Be the kind of person money arrives to, even a little, so that when the floor moves up, some of your life moves up with it, instead of all of it moving against you. The Honda driver with the funded account isn't winning because they're frugal. They're winning because, almost by accident, they ended up on the arriving side of the floor instead of the owing side. They built less front door and more room behind it, and the room behind it is the part that just started paying. But there's a catch that almost nobody warns you about. Knowing that safe money finally pays is not the same as being allowed to collect it efficiently. And it only helps if the money is actually sitting in a competitive place, instead of under-earning in a lazy bank corner while inflation and taxes keep chewing through it. Because where you keep your money is governed by rules that have nothing to do with how good your instincts are. The access problem is obsessed with the wrapper, the container your money sits in, because the wrapper, not the money, often decides what you actually keep. Here's what that means in plain terms. The same dollar of safe interest can be taxed heavily in one kind of account and barely at all in another. Two identical dollars, same yield, and one of them quietly hands a slice back to the tax bill every single year, while the other one keeps the whole thing. There are accounts built for retirement that let your safe yield grow without the yearly tax bite, but they come fenced with rules. There are age gates. Take the money out too early and you get penalized, because the deal was leave it alone until later. There are income limits, often written against a number called your MAGI. Basically, your income after a specific set of adjustments that quietly decide whether you're even allowed to use certain accounts this year. And there is timing. When you contribute, when you convert one kind of account into another, when you pull money out, can change your tax bill by a meaningful amount for doing the exact same financial thing a few months apart. In the early retirement version of this problem, the hidden price isn't only tax, it's usability. Healthcare premiums, subsidy cliffs, penalty windows, and the years before standard retirement access can turn a perfectly respectable pile of money into money you still can't use cleanly when you actually need it. The access lens isn't trying to make you an accountant. The point is simpler and a little uncomfortable. In a world where the floor finally pays, the reward for safe money goes disproportionately to the people who put it in the right wrapper. Two people can save the identical amount, earn the identical yield, and walk away with meaningfully different outcomes, not because one was smarter about the market, but because one understood the age gate, the income limit, the timing window, and the other left their safe money sitting somewhere. The rules quietly taxed it down year after year without ever sending a warning. So now let me reassemble the whole machine, because you're holding all four pieces. There's a floor, one rate, the cost of safe money, set far above your head. When it rises, it reprices the borrowed, visible side of your life. The mortgage quote, the car payment, the rent renewal, the frozen hiring plan, the squeezed payroll, the strained city budget. And even the insurance premium that rises because the whole repair and risk environment above it got more expensive. Every one of those is the same number wearing a different costume. At the very same moment, that rising floor finally pays the saved, invisible side of your life. The boring account, the safe yield, the line on the retirement statement that used to do nothing. And whether you actually capture that reward depends less on how much you save and more on the wrapper you save in, the age gates, the income limits, the timing, which brings us all the way back to two cars at a red light. The whole trap of a high-floor world is that it makes the visible side of life more expensive at the exact moment it makes the invisible side more valuable, and almost all of our instincts. All of our status reflexes, all of the things that feel like doing well, point at the visible side, the bigger car, the nicer front door, the version of okay that other people can see. Meanwhile, the thing that's quietly being rewarded is the version of okay that nobody can see at all. The funded account, the paid-off title, the wrapper set up correctly, the money that arrives instead of the money you chase. The driver of the SUV isn't foolish. They're responding completely rationally to a lifetime of signals that said the visible side is the side that counts. They just happened to keep building the front door right as the floor underneath the whole house shifted to reward the room behind it. I'm not going to tell you the answer is to drive the dented Honda and feel superior about it. That's just status in reverse. The answer is more honest than that, and it's smaller. It's to know which side of the floor each of your decisions sits on. So let me leave you where I always do. Not with advice, but with an audit. A few questions to sit with, slowly, the way you'd sit with a number you finally understand instead of one that just shows up and scares you. 1. What rate exposure does this create? Of everything in your life that costs you money each month, how much of it is borrowed, riding on top of that floor, repricing against you when it rises, and how much of it is owned, arriving to you, working in the same direction the floor moves? You don't have to fix the ratio today. You just have to know it. Most people have never once said it out loud. 2. What monthly obligation follows it? When you imagine doing well, what did the picture add to the number your life now has to earn every month before it can feel calm? Which bill became load-bearing? Which visible upgrade quietly taught the rest of your life to cost more around it? 3. What optionality disappears? Whose eyes are you imagining success through? Is the picture in your head something other people can see, the front door, or something only you would ever know is there, the safety behind it? Because the floor we live under right now quietly rewards the second one and quietly punishes the first. And every time you choose the visible side at the expense of the invisible one, some future freedom usually disappears with it. 4. What hidden rule decides the real cost later of the safe money you already have, even if it's small, even if it's just the boring account? Is it sitting in the right wrapper? Have you ever actually asked whether the age gates, the income limits, the timing rules, the healthcare premium cliffs, or the access windows are working for you or quietly taxing you down? Because in a world where the floor finally pays, the reward goes to the people who answered that question, and it skips completely the people who never knew to ask it. 5. Does this make my future calmer or tighter? You didn't vote for the floor. You'll never see it. But you pay it, or it pays you. Every single day. And the only real choice you have is whether you build your life on the side of it that's lit up for everyone to admire, or the side of it that's quiet, invisible, and holding. I know which car I'd rather be driving when the light turns green. I'm Nora. Look at the floor.